Thank you guys very much. You know, one of the first lessons, excuse me, I don't really even need this, I don't think. One of the first lessons that we all can glean from this is just how different venture capitalists are. Their interests are different, whether it's the type of industry, the marketplace, deal size, stage of development, and we heard that, you know, just from a small sampling of venture capitalists. So I think one of the first things that's a great takeaway from today is before you begin your fundraising process, do your homework. Think about who the appropriate investors are for your company and for what you do. You know, just between Gil and Jay, we see a difference between consumer-facing companies and business to B2B-facing companies. And it's very important for you, as someone who's seeking capital, to make this the most productive and efficient process you can, and make sure you're approaching the right people. So, you know, with that, I thought one of the first things we might want to talk about is the current fundraising environment. There's been a lot of talk about how the best of times are behind us. I'm not sure that I totally agree with that. I think it's a more disciplined period than it might have been in 14 and 15, but these are still some pretty good times to raise money. I'd be very interested in what your thoughts are.
So, there's more money available now than there's ever been. There are more companies getting funded at every stage than there's ever been. You know, we saw last year 700 companies and met with probably close to 300 of those companies, actual meetings or first calls with those companies. So there are, you know, and I don't know how many of those 700 got funded, but we funded 2 of them. But that's not atypical for us. We do maybe a few deals a year. But there are countless angel investors, there are seed stage funds, institutional funds, there are angel groups that are out there. There are also larger funds, that's a multi-$100 million funds who are making early stage bets. You know, I'm seeing companies that we've seen and passed on get funded, and that might not be, you know, a bad thing. They're probably a good company, just wasn't a good fit for us. So we see tons of companies getting funded. I don't think that there is a lack of capital for good companies out there.
I think I second that one over here, which is that for a really good company or a really good startup idea, there's a lot of capital available. The one thing that I've seen, at least in the venture community, is that companies that used to get funded before, that you were like, hey, I don't know if that's a great business or not, are not getting funded anymore. And even more so, I'm seeing companies that maybe had a couple of funding rounds and they need to get a B round and they're, you know, not really crushing it, but they're kind of like just floating by. Those companies where a couple of years ago they were getting follow-on funding, they're not getting that anymore. So like the well, I believe, has really dried up for companies where they've gotten a couple rounds of funding and they just haven't shown the traction that investors want to see. And that money has now gone to like, hey, let's put our money into companies that are really interesting, really exciting, and really having fast growth. So just within our portfolio alone, the companies that just are having really strong growth have had no problem raising a lot of money very quickly in the next rounds. And the companies that are just, you know, kind of like getting by, they've had a really hard time no matter how many meetings they do. And sometimes we tell them, look, just stop doing meetings, spend the next 2 months, 3 months fixing the product, fixing the customer experience, doing all the things that you need to do to really get the growth that you need in order to go out there successfully. So that's kind of like the way I've been seeing it.
So if you hear the macro news on what's going on, you know, following up on what David said, and if you look at Thomson Reuters report on what they came out on 2016 investments, it's down. But I only have a micro view on what's going on in New Jersey, and I'll tell you, the community in New Jersey is extremely active. We committed to 2 new venture funds at the end of the year, as I said, the Tech Council Venture Fund and Newark Venture Partners. So that's going to put more money to work in the state of New Jersey. The Angel Investor Tax Credit Program that I mentioned briefly gives us an eye to the companies that are getting funded. And we saw 50, check my numbers, make sure they're right here, 57 unique companies get funding from angel investors in the state of New Jersey for that $96 million that I mentioned. And And those are just the ones that we saw come through our doors on the program. I think what is interesting is the average size investment from those angel investors was between $500,000 and $1 million. And that made up the bulk of the investments that we saw. There was a few outliers. We also saw unique trends in the state where companies traditionally would go to VCs were raising big rounds. So we saw there was a public press release on a company in Bridgewater that raised $55 million during angel rounds. You didn't hear about that years ago. That's a pretty big round. So I said to somebody earlier, what I generally see is New Jersey lacks the national trends, and for right now things are very frothy for all the entrepreneurs that I talk to in their ability to access capital. We're also seeing a lot of capital come from overseas, particularly on the biotech side. And this company that I mentioned is certainly in the life science sector that raised the $55 million. So nobody I see is hurting for cash right now. There is a lot of capital out there. And following on David's comments, you got to be smart about who you're taking the money from. But there's more VC money, there's more angel money, and as I mentioned, there's significant tax credits and incentives through the state. So I think it's really supporting our local economy in a very different way that is not in line with what we're seeing on the national trends.
Thank you. I would say to add to that, I think there clearly are cycles, investment cycles. I mean, so I've, as I said, spent the last 3 years now in a corporate fund. Prior to that, I spent 10 years in a financial VC fund. Prior to that, I spent 5 years as an investment banker at Goldman Sachs in New York. And so I think through that time frame, I've seen several cycles. I would say that venture investing is certainly on an upswing. It did go through a very significant downturn, pretty much after some of the tech and telecom bust happened, and it's taken a while for things to come back up again. I think it is true that there is money out there, but I think the sources of capital have changed somewhat. I think there's a lot of money from overseas, as Kathleen just said, particularly from China and from the Middle East. And we see a lot of that showing up in deals that we look at. I would say that the number of financial firms is actually probably going down somewhat. If you just look at the stats from the National Venture Capital Association. However, I think that shortfall is actually being made up by corporate funds. So the stock market's obviously been through a down cycle, it's now in an up cycle. And a lot of corporations are flush with cash. And generally these corporations are doing, one of three things. One is they're doing stock buybacks, which obviously push up their stock. Two is they're doing a lot of acquisitions, so you see a pretty active M&A market. And three is they're starting corporate venture arms. So everyone from BMW to Shell to GE to Bertelsmann, all these groups I mentioned all have corporate venture arms, and I think that's a trend you're going to see increasing. So there's a lot more money coming from corporations. I think similarly though, as you look at a lot of financial funds, you see a number of financial firms that are effectively just managing their current portfolios but not doing new investments. And I think that's happening a lot. I think also what you see is a lot more money focused on consumer tech, not as much money focused on what I call industrial tech from the traditional financial venture funds. So it's sort of a mixed bag. Yes, there is money, but it is from different sources.